S corporation taxation. All right, all right, all right. So some things here we have seen before, some things we're going to dive into more in depth. So S corporations are considered pass-through entities for tax purposes. And if this is something that you're not familiar with by this point, definitely should be. We've gone through whether it was our business structures lessons or the first one here for S corps. This means that the corporation itself generally does not pay federal income taxes. We say generally because, well, what's a great way that they will pay tax? We'll see this in point 2, but really more so focusing on the built-in gains tax. Instead, the income, deductions, credits, and losses of the S-Corp pass through to its shareholders, who they themselves are going to report and pay taxes on their individual income tax returns. However, there are a few exceptions and additional taxes that may apply at the corporate level. But first off, no corporate level tax. The primary advantage is that generally there's no tax at the S-Corp level. Everything flows to the individuals who pay taxes based on their personal tax rate. However, we do have exceptions for that corporate level taxation. So generally they don't pay the federal taxes, but when will these taxes be assessed at the 21% corporate rate? Some examples include, now built-in gains tax we did go through in the prior lesson, but the LIFO recapture tax, not as important, but we'll go over it. Obviously, you'll see the built-in gains tax probably a little bit more. If an S-Corp was previously a C-Corp and used the LIFO inventory method, it must include the difference between LIFO and FIFO in its last tax return as a C-Corp. This difference, known as the LIFO recapture tax, is subject to corporate level tax. This is something also, just the concept of LIFO recapture. I can't even remember which exam it used to be tested on because it hasn't been in a while. It's really quite such a theoretical and strange concept. But anyway, that's why I'm not really dealing with that too much. The built-in gains tax, this is something we saw in the previous lesson, but just as a good reminder, if the S-Corp was previously a C-Corp and holds assets with a fair market value greater than their adjusted basis, it may be subject to this tax. Now, the goal here is the IRS doesn't want you to have a C-Corp and you buy a bunch of stock, equipment, property. It all goes up in value in the next 3 years. You become an S-Corp just to avoid all of that double taxation and then sell it, distribute it. That's what the IRS is trying to avoid here. This tax applies when the S-Corporation sells these assets within 5 years after the S-Corp election. Basically, the IRS is saying, all right, if you've been an S-Corp for 5 years, you're probably holding on to it long enough, or, that's just their rule. I mean, I could just say that's the rule, but I always like to give some sort of explanation or insight into what the IRS would think. Maybe I should go get a job at the IRS and redo these lessons because then I'd be able to kind of explain a little bit more what they're thinking. But these are the mentalities that I interpret. So the IRS does not want you to become an S-Corp just for the sole purpose of flipping all your assets and not having to pay tax on it. But if you're an S-Corp for 5 years, okay, if you've held those eligibility requirements for 5 years, you're probably a legitimate S-Corp. Lastly, here we've got the exceptions to the built-in gains tax. Well, it does not apply in the following situations. If you were an S-Corp for more than 5 years after the election and then sold the assets at that point, again, kind of like a statute of limitations. If you wait 5 years and then sell those assets, you're not going to have that clawback about being a C-Corp. Appreciation occurred after the S-Corporation election. So if you bought an asset after you became an S-Corp, that's considered S-Corp, so you're not going to pay tax on that. An asset acquired after the S-Corp election. So any appreciation or asset acquired, either of these, kind of similar in that sense, but no matter what if you had the activity while you were an S-Corp, you're not going to have to worry about C-Corp taxations. I mean, that wouldn't make sense, right? We're an S-Corp now. We're not going to get just slugged in the head with C-Corp regulations and tax. And that is a good amount. Let's keep going through. You're doing great. I'm sure you are. Make sure you're stretching, doing some coffee, do some push-ups, do some jumping jacks, whatever you got to do to get the blood flowing. Have a smoothie. I myself am quite a fan of smoothies. Keep going. We will get through this. All right. Now, this is dealing with the LIFO recapture tax. Like I said, this is not as important. So I am going to briefly go over this and briefly go over it. If you want to pause the video and read it for yourself, feel free. Again, this is not as important, but if you wanted to kind of see this, I'm going to actually start with the IRS rationale because, well, what's the reason behind all of this? The reason behind this recapture tax is due to the differing tax structures of C-Corps and S-Corps. A C-Corporation is taxed at the corporate level, right? And then again at the individual level, whereas an S-Corp is only taxed once. The IRS rationale here is to prevent corporations from benefiting from the deferral of income as a C-Corp using the LIFO method and then avoiding the double taxation normally dealt with here. The LIFO recapture tax will accomplish this by essentially treating the built-up LIFO reserve as income. And this, again, like I said, this is tested on one of the other exams. I know we're dealing with exam changes all the time. Don't worry too much about where it was tested because, again, it was never really tested. But essentially, if you change methods, there's kind of this bubble because we think about your cost of goods sold and your inventory levels are different depending on what method you use. So if you go from LIFO to FIFO, there is this essentially built up bubble that needs to be accounted for. And this does have impacts when it comes to kind of corporate accounting and financial accounting, as well as operations, but also obviously with taxes. So this is, again, not going to go into it too hard, but just overall, this is kind of what's going on. Just again, it's really not worth it to go too much, but if you wanted a good idea of what's going on here, having LIFO and then period of rising prices, which is generally what happens, like that's what's normal because inflation does occur every year. It's just that's life, right? We're always paying more for everything. This can increase the cost of goods sold and decrease taxable income. And because you're using LIFO, it creates, again, this bubble because prices are always going up, but you're using the last in, first out. So you're constantly getting a higher tax deduction for it. I know I said I wasn't going to go into it too much, but I'm continually going in. But, hey, I'm just interested in this stuff because I'm an absolute crazy person. So again, if you are using LIFO, you're using the last in, first out, which is generally using in a period of rising prices, which again is the norm for real life. You are getting higher and higher cost of goods sold, and maybe you never really get to your first in, first out. You never get to your first assets that you purchased, your first inventory that you purchased. So there's essentially a bubble that you have to pay tax on. That's what this is dealing with. I'm going to pause myself there because I know I said I was going to cut myself off. Again, if you're interested in this, read it. I mean, there's maybe a 0.05% chance you'll see this on the exam, but this is there if you wanted to read up on it. Time to run through some examples. First off, we've got the LIFO recapture tax. Now, ABC Corp was a C Corp using the LIFO inventory method and had inventory with a LIFO value of $100,000 and a FIFO value of $120,000. In year one, ABC Corporation elects to become an S-Corp. In the last tax return as a C Corp, ABC Corp must report the LIFO recapture amount of $20,000 as income. And lastly here, ABC Corp will be subject to corporate level tax on the LIFO recapture amount of $20,000 at a 21% rate. So that's the calculation there. Next up, we have a built-in gains tax example. In year one, ABC Corp elects to become an S Corp. At the time of election, ABC Corp owns an asset with a fair value of $150,000 and an adjusted tax basis of $100,000. The built-in gain is $50,000. So at the time of election, meaning it was a C corporation before this, so they have $50,000 of built-in gain. Now in year three, and since year three is less than 5 years after the election, ABC Corp sells the asset for $160,000. We're going to have a nice little built-in gains tax situation going on here. The built-in gains tax at the corporate level, that is going to consist of that $50,000 of value that was accumulated while it was a C Corp, taxed at the highest corporate rate. Next up, here's just an example where there is no built-in gains tax, just building on that more than 5 years after election, so seeing numerical examples of that. In year one, ABC Corporation elects to become an S Corp. At the time of the election, ABC Corp owns an asset with a fair market value of $150, so similar to the prior question as well, information here. But in this case, we sold the asset, doesn't matter for what amount, because it was more than 5 years after the election. It was in year 7. So the built-in gains tax does not apply because the asset sale occurred more than 5 years after the S corporation election. Now, these examples demonstrate how the LIFO recapture tax and the built-in gains tax may affect an S corp's taxation. Remember that these taxes are exceptions and apply in specific situations, while S corporations generally do not pay federal income taxes at the corporate level. I think that sounds good to me. Sounds good to you. We will move along. All right, more taxation of S corporation income. Here are just kind of facts, tidbits, aspects, attributes that you should know. S corporations are pass-through entities. We're going to beat the phrase to death, which means that the income earned by corporations are passed through to shareholders and reported on their individual returns. Some key points here. First off, they're not subject to self-employment tax. Income earned by an S corp is not subject to self-employment tax. This is because an S corporation income is considered to be a return on investment rather than earned income. It is allocated based on a per share per day basis. Now, S corporation income will be allocated to shareholders based on the number of shares that they own and the number of days they own those shares during the year. This is referred to as a per share per day basis. This concept as well is important. You can see questions saying the person owned 20% of the company, but they only own that for 1 day of the year. So you would do 20% of the income for the full year times 1 divided by 365. Taxed when income is earned, not when distributed. So unlike C corporations, S corporations are not taxed on their income. Well, just because there's single taxation here. Instead, income is taxed when it's earned by the corporation and passed through to the shareholders. This means that shareholders must pay taxes on the income even if it has not been distributed to them. Lastly, only includes business income and expense. Income in an S corporation only includes business income and expense. All of these other items, these are what we'll refer to, as we've seen before, as separately stated. Even though essentially the ordinary business income still flows through and ends up becoming separately stated, yes, this does originate on the face of the 1120S. Here is a beautiful example. Let's say that XYZ Corporation is an S-Corp with 2 shareholders, John and Jane, who each own 50% of the company. Now, the company reports $100,000 of net business income for the year. The income is not subject to self-employment tax and is based on a per share per day basis, which it didn't have to tell you that. It's just telling us that because that's the rule we just learned, but just keep in mind, a question does not have to state that. The income is taxed when it's earned, not when it's distributed. So again, just building out our rules that we've been seeing over the past couple slides. Additionally, the income only includes business income and expense, while the other items are reported by shareholders on their individual schedules. Now, here's an example of the per share per day basis. Since John and Jane each own 50% of the company, they're each entitled to 50% of the company's income. So let's say that the company had 365 days in the year. If this isn't stated, they might say 365 days or 366, right? We got leap years, all that good stuff. I would assume 365, go with that by default. Now, John's per share per day income will be calculated as the following: $100,000 divided by 2 shares divided by 365 days. That's going to give us $136 roughly, round that up to 137 per share per day. Jane's share amount per share per day is also going to be that same amount. If a shareholder only held shares for, let's say, 10 days of the year, we would multiply that by 10. Let's talk about the concept of income being taxed when it is earned. Since S corporations are pass-through entities, the income is taxed when it's earned, not when it's distributed. That means that John and Jane must report their per share per day income of roughly $137 on their personal tax returns, even if it is not distributed to them. Similar to partnerships, as we will see as well. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.